I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. The two notable laggards in the market's recovery from its COVID lows in late March have been the energy and bank sectors. Three of the four major banks will be releasing their fiscal 2020 results in the next few weeks. This comes as the stocks have recently recovered some of their lost ground. To maintain this momentum, they will need to show signs of diminishing risk and even improved performance in the latter part of fiscal 2020. The key area of focus for us will be 1. Loan book growth. After a long period of slowing loan book growth, recent data has flagged an acceleration in mortgage applications. Additionally, the major banks have been winning share through the middle of the calendar year on the back of sharp reductions in fixed mortgage rates. Non-banks have re-entered the market from July. Investors will be looking for commentary around the current competitive dynamics and potential impact of unwinding responsible lending requirements to see if there's any signs that loan book growth could start to accelerate. 2. Net interest margin and outlook. Underlying net interest margins are expected to fall around 10 basis points in the 6 months to September due to limitations on deposit rate reductions relative to lending rates as the RBA cut its official overnight rate to 0.25%. The NIM also faces an ongoing headwind from front book discounting and falling returns from liquid non-loan book interest-bearing assets. The low interest rate environment will test the ability of the banks to lower term deposit rates sufficiently to offset the falls in lending rates. Ongoing substitution from term deposits to zero interest-paying transaction accounts might also provide some offset to the falls in lending rates. 3. Credit quality and provisioning. This will be a key area of focus for markets. However, with repayment deferral provisions likely obscuring borrower stress, these results are not likely to provide any more information to investors regarding the medium-term outlook for bad debts. With the economy having generally performed better than initially expected on the back of aggressive fiscal and monetary stimulus, the material collective provision overlay increases taken at the first half results could be wound back slightly in the second half. The big question is what happens to arrears levels once repayment deferrals end for borrowers. This is not likely to become clear until the next set of results in May. 4. Capital. Deferred or cancelled dividends combined with asset sales have bolstered the equity capital levels for the banks. At some point, rising arrears will see risk weights increase, diluting regulatory capital ratios. However, this will not become material until loan repayment deferrals have largely ended and any remaining borrower stress flows through to arrears data. This is not likely to be evident in this set of results, but investors will be looking for updates from management on the outlook for risk weights. That's it for this week. We will be back next week. In the meantime, you can follow us on Facebook and Twitter.